general overview of the EPS ratio by going through 3 chapters. The first chapter will go over the calculation of the EPS ratio, then I'll walk you through an actual balance sheet example, and the last chapter will be reviewing some of the limitations of the EPS ratio. Now, a quick disclaimer, I am not a financial advisor. You oversee your investment decisions and I am not liable for any results based on them. Now, let's begin. Our first chapter will be regarding the calculation of the EPS ratio by walking through its formula. Now, EPS stands for earnings per share. It is calculated by dividing a company's earnings by the number of shares outstanding. A company's earnings is equivalent to its net income, which we divide by the shares outstanding, and a company's net income comes down to its revenue minus expenses, which is divided by the shares outstanding. In general, revenue is how much a company makes, expenses is how much a company spends, and shares outstanding are the number of shares available to be traded in the open market. Now, I'm going to provide some examples of revenue and expenses for 4 different companies. The first company is going to be called Frosty Delights. It's an ice cream company, so its revenues could come of ice cream sales, whereas its expenses could be the cost of ingredients, such as milk. The second example is a company known as Horizon Airlines. Its revenues could come from ticket sales, whereas its expenses could include airline fuel. Third example is Tech Gadget Innovations, a company that sells technology. Its revenues would come in smartphone sales, whereas its expenses include marketing costs. And the final example is going to be Health Plus Pharmaceutical. Its revenues come from selling prescription medication, whereas its expenses include research and development. Think of another company and example of what its revenues and expenses would be. Add your example in the comments below. Another type of EPS is known as the diluted EPS, also known as diluted earnings per share. The diluted earnings per share is equivalent to company's earnings divided by its diluted shares outstanding. As we recall, earnings is the net income, which was divided by the diluted shares outstanding, and the company's net income is revenue minus expenses over the diluted shares outstanding. As we can see, the revenue minus expenses are going to be the same as the regular EPS. The only difference with the diluted EPS is that we divide the revenue and expenses by the diluted shares outstanding. I'll clarify this with a visual representation. So just as a reminder, revenue is the money made, expenses is the money spent, and diluted shares outstanding are the shares in the open market, both direct and indirect. Now, what do I mean by that? Well, the simple EPS includes the number of shares available to be traded in the open market. The diluted EPS includes the same shares outstanding plus the potential shares outstanding. In other words, diluted shares are the extra shares that could come into play if things like stock options or convertible bonds were converted into regular shares. Now that we've considered this difference, let's move on to an example and calculate both the simple EPS and the diluted EPS. I'll now walk you through an actual balance sheet example for the company known as Apple. Now, remember, this is not a recommendation to buy, sell, or hold Apple. It is simply an example of how to use Apple's balance sheet to calculate its EPS and diluted EPS for a given quarter. I am just using the current numbers on its website to calculate the EPS. Now I'll walk you through where and how to find the key values necessary for calculating EPS for Apple from its balance sheet.
Great, now let's walk through Apple's financial statements to calculate the EPS ratio. To search for Apple's earnings, we can do Apple Investor Relations. This will lead us to Apple's Investor Relations page. Once we click on that, we can go down to Apple's financial data, and here we can see the quarterly earnings report. The most recent earnings report is Q2. However, given the values, I'm actually going to be going over Q1, which is a clear example of differing EPS values. Once we click on financial statements, we can see that the Apple condensed consolidated statements of operations. Here we have Apple's net sales, cost of sales, operating expenses, operating income, net income, earnings per share, shares used in computing earnings per share. Here we can see how much Apple made in this quarter and how much it costed. So how much Apple made is actually its net sales. Here we have that from its products, Apple made $96,458 million. From its services, it made $23,117 million. And thus, its total net assets, which is composed of products and services, is equivalent to $119,575 million. Now, this is the net sales. How much did this cost Apple? Here we have the cost of sales. So the cost of the products is going to be $58,440 million. The cost of its services is going to be $6,280 million. So the total cost of the sales, which is equivalent to the products plus the services, is equivalent to $64,720 million. And once we subtract the total cost of sales from the total net sales, we have 119,575 minus 64,720, which is our gross margin, or $54,855 million. On top of that, Apple also has operating expenses. These operating expenses include research and development, which is $7,696 million, and selling, general and administrative, which is equivalent to $6,786 million. Apple's total operating expenses were $14,482 million. Thus, Apple's operating income, which is the gross margin subtracted by the total operating expenses, is equivalent to $40,373 million. Alongside that, Apple had other income or expenses if it's in parentheses, and given that this $50 million is in parentheses, then this was a cost. So we subtract 50 from $40,373 million. This leads us to Apple's income before provision for income taxes of $40,323 million. Lastly, we incorporate the provision for income taxes, which was $6,407 million. So Apple's net income is $33,916 million. So that is going to be the earnings in our earnings per share value. Now, the number of shares that we're going to be using is actually right below the EPS. Here we have shares used in computing earnings per share. So the basic number of shares are going to be 15,509,763, and we can tell that this is going to be in thousands. Here we can see that accept number of shares, which are reflected in thousands. We also have the diluted number of shares, which is going to be 15,576,641 thousands of shares. So now that we have these values, let's walk back to the calculation of Apple's EPS. So we know that we should be getting 2.19 and 2.18. Now let's take a look and walk through this step by step.
Now let's insert the values into the formula. As we remember, EPS is equivalent to revenue minus expenses divided by the number of shares outstanding. Apple's revenue is $119,575 million. Its expenses are $85,659 million, and its shares outstanding are 15,509,763,000 shares. Doing the math leads us to a basic EPS of $2.19. Now let's calculate the diluted EPS. We subtract the same revenue and expenses, but now we use the diluted number of shares outstanding in the denominator. The diluted number of shares outstanding are 15,567,641,000 shares. Implementing this value into our formula results in a diluted EPS of $2.18. As we can see, given that the value in the denominator is greater for the diluted EPS value, the diluted EPS value is lower than the simple EPS value. Now, basic EPS of $2.19 means that for each share of common stock outstanding, the company has earned $2.19 in net income over the given period, usually in a quarterly or yearly basis. A diluted earnings per share of $2.18 means that the company has earned $2.18 over the same period, but the figure accounts for the potential dilution effect of convertible securities, such as stock options or convertible bonds. That could increase the total number of shares outstanding. Diluted EPS provides a more conservative measure of earnings per share by considering maximum potential dilution impact on existing shareholders. Now let's move on to the next important topic, which is the limitations the EPS ratio has. The first limitation is the company's ability to manipulate earnings. A company can delay or defer expenses to future periods, which will boost the current EPS. This can include postponing necessary maintenance costs, R&D expenditures, or marketing expenses. Another limitation is a company's ability to control the number of shares in the calculation. If a company decides to increase its numbers of shares, it could thus decrease its EPS value. On the other hand, if a company decreases its numbers of shares, it can increase its EPS value. Lastly, there's the concept of changing conditions. The COVID pandemic is an example of when a company's prior earnings may have been positive and the pandemic led to their costs exponentially increasing and their earnings becoming negative, in which case their positive EPS ratio would make the company seem profitable until the next quarter, when the earnings turn negative, which could lead to a drastic change in sentiment regarding the company. And one more note before the conclusion is a quick shout out of credits. Thanks to Slides Carnival and Unsplash for free resources. If you want to learn more about how the EPS is used to calculate the PE ratio, click on my next video here. Make sure to drop a like and subscribe for more videos coming up soon. Happy investing, and until next time.